Inside millions of 401ks across the country, there is a silent killer of retirement dreams. It's not a risky stock or a market crash. In fact, it's marketed as the exact opposite. It's sold as the safest, simplest, most responsible choice you can make. It's the set it and forget it solution that your HR department probably recommended. I'm talking about the target date fund. And today I'm going to show you why, for many people over 50, this supposedly safe investment is actually a retirement trap, systematically sabotaging your chances for a comfortable future. We're going to pull back the curtain on how these funds really work, why they're core. Strategy is fundamentally flawed for the modern world, and what you should be doing instead to maximize your growth in the most critical decade of your financial life. Disclaimer: I am not a financial advisor. This is for educational purposes based on my research and experience. The idea behind a target date fund is brilliantly simple. You pick a fund with a year in its name that roughly corresponds to when you plan to retire. For example, if you're 50 today, you might be in a Target 2040 or Target 2045 fund. The fund then automatically adjusts its asset allocation over time. When you're young, it holds mostly stocks for aggressive growth. As you get closer to that target date, it automatically and gradually shifts more of your money into bonds to reduce risk and preserve capital. It sounds perfect, right? It takes all the guesswork out of investing. It prevents you from making emotional mistakes. It's the ultimate easy button for your retirement savings. And for someone in their 20s or 30s, it's a perfectly reasonable, if not optimal, choice. But for those of us in our 50s, this automatic, one-size-fits-all approach can be devastating. Why? Because the core premise of the target date fund is based on an outdated model of retirement. These funds were designed for a world where people retired at 65 and had a life expectancy of maybe 75 or 80. Goal was to get you to retirement with your capital intact. The fund's job was essentially done on your retirement date. But that's not our world anymore. Today, a healthy 65-year-old can easily live to 90 or beyond. Your retirement could last 25, 30, or even 35 years. You are not just saving for retirement anymore. You are saving for a multi-decade period where your money needs to continue growing just to keep pace with inflation. The biggest risk you face is not a market crash in the year you retire. It's the slow, corrosive risk of running out of money in your late 80s. And this is where the target date fund trap is sprung. Let's look at what happens inside a typical Target 2040 fund. Right now, at about 15 years from its target date, it might hold around 75% stocks and 25% bonds. That's still reasonably aggressive. But over the next 10 years, as you approach age 60, that allocation will automatically shift. By the time you're 5 years from retirement, it might be 60% stocks and 40% bonds. And on your retirement date, it could be as conservative as 50/50ths. This process is called the glide path. The fund is gliding you in for a safe landing. But what it's actually doing is systematically taking its foot off the gas during your most critical growth years. It is de-risking your portfolio at the exact moment you need to be taking calculated risks to build the nest egg you need for a 30-year retirement. Think about it. You're in your 50s. These are your peak earning years. You're finally able to make those catch-up contributions. You are pouring more money into your 401k than ever before. And right at that moment, your target date fund is quietly selling your stocks and buying low-yield bonds. It's like filling up your race car with premium fuel, only to have the engine automatically governed to go no faster than 40 miles per hour. Another hidden danger is the one-size-fits-all nature of these funds. Your Target 2040 fund is identical to the Target 2040 fund of your 50-year-old colleague down the hall. But are your financial situations identical? Of course not. Maybe you have a pension from a previous job, and they don't. Maybe they have a large inheritance, and you don't. Maybe you're in excellent health and plan to work until 70. While they have health issues and need to retire at 62, a target date fund treats you all the same. It makes no adjustments for your personal risk tolerance, your other assets, or your unique life goals. It's the definition of generic advice. Furthermore, many of these funds are shockingly expensive. They are often a fund of funds, meaning the target date fund itself is just a wrapper that holds a collection of other mutual funds from the same company. You end up paying fees on top of fees. An expense ratio of 0.75% or higher is common. That might not sound like much, but on a $500,000 portfolio, that's $3,750 a year. every year being skimmed off the top. Over a decade, that's tens of thousands of dollars in fees that could have been compounding in your account. So, if the default option is a trap, what's the alternative? It requires a little more work, but it puts you back in control of your financial destiny. The solution is to build your own simple, low-cost, 3-fund portfolio. This is not as complicated as it sounds. You are simply going to replicate the basic idea of a target date fund, but with better, cheaper ingredients and an allocation that is appropriate for your goals, not a generic formula. Here are the 3 funds you need. 1. A U.S. Total Stock Market Index Fund. This gives you a piece of every publicly traded company in the United States, from Apple and Microsoft down to the smallest startups. It's the engine of your growth. 2. An International Total Stock Market Index Fund. You don't want all your eggs in one country's basket. This fund gives you exposure to thousands of companies across Europe, Asia, and the rest of the world. 3. A U.S. Total Bond Market Index Fund. This is your anchor. It provides stability and income, and it tends to do well when the stock market is doing poorly, smoothing out the ride. That's it, 3 funds. You can find low-cost versions of these from providers like Vanguard, Fidelity, or Schwab, often with expense ratios below 0.05%. That's a fraction of what you're likely paying for your target date fund. Now, the most important part, the allocation. If you are in your 50s and in good health, you have a 25 to 35-year time horizon. You are still in the growth phase. A 50/50th stock-bond portfolio is far too conservative. You should consider an allocation that is still heavily weighted towards stocks. Something like 80% stocks and 20% bonds is a much more appropriate starting point. So, your portfolio might look like this: 50% U.S. Total Stock Market Index, 30% International Total Stock Market Index, 20% U.S. Total Bond Market Index. This portfolio is still aggressive, as it should be. It's designed to maximize your growth during your final, highest-earning years. And the best part is, you are in control of the glide path. As you get closer to retirement, say in your early 60s, you can manually adjust the allocation. You might decide to shift to 70% stocks and 30% bonds. You make the decision based on your life, your risk tolerance, and market conditions, not based on an automated formula that treats you like a number. Breaking up with your target date fund can feel intimidating. It's been your financial security blanket. But it's a false security. It's the comfort of mediocrity. It's a path designed to get you to the finish line, but the finish line has moved. To win the new game of retirement, you need a strategy that lasts for decades past your retirement date. You need a strategy that keeps working for you, that keeps growing, and that you control. Taking this one step, exchanging your expensive, overly conservative target date fund for a simple, low-cost, self-managed 3-fund portfolio could be the single most profitable financial decision you make in your 50s. If this video made you rethink what's inside your 401k, hit that subscribe button. We're here every week to challenge the conventional wisdom that is holding you back.